Hello, this is Rick Cortez. I'm co-CEO of Broadmark Asset Management, and this is the monthly June 2023 update on the Westwood Broadmark Tactical Growth Strategy. And today I'd like to highlight the fourth pillar of our investment process, momentum. We are seeing a narrowness of the advance this year that you have to go back decades to find other periods like this. For instance, the top 10 stocks in the S&P 500 now account for over 90% of this year's performance. The cap-weighted S&P 500 is up over 10%. The equal-weighted is only up about 1%. And all of this is a global phenomenon. The top 20 tech stocks in the world account for 1/4 of the MSCI ACWI index. That's the all-country world index, which rivals the dot-com bubble top. And finally, if we take the percentage of stocks in the S&P 500 that have actually outperformed the S&P 500 this year, it's the lowest in many decades. You have to go back to 1972 during the Nifty 50 rally to find something comparable. So what does this mean? Well, narrow leadership has often led to subpar performance in the next 12 months to 18 months. That's number one. Number two is that these things have happened, generally speaking, prior to bear markets. I would caution us, though, that sometimes these rallies continue and continue and continue. So just because it's happening now doesn't mean we're imminently on the verge of a decline. And when we look at our other three pillars of our investment process, valuation is negative. The median PE is 24 times earnings of the S&P 500. The average over time is 17.5. We're still 35% above fair value. And monetary policy is also leaning negative. Even if we've seen the final hike for this cycle with a May increase, and maybe they'll increase next week or the week after when the Fed meets in June, nonetheless, if we look at history, during the 14 previous tightening cycles, the market has been lower 6 to 12 months after the final hike more than half the time. The one area that's not really bearish is investor sentiment. The S&P is up, the tech stocks are up, the rest of the market's languishing, the VIX is down at 15, there's more complacency there. But you put all this together and we're cautious. So we are now positioned in our separately managed accounts with 25% allocated to the S&P 500. We usually use the SPY ETF. And we have 75% of our separately managed accounts in 1 to 3 month treasury bills. We usually use the BIL ETF. And as of May 31st, the 13-week treasury bill was yielding 5.52%. So we would raise exposure if our volume and breadth models really started to pick up and interest rates stayed low, or as low as they are now. We would decrease exposure and possibly take short positions if our volume and breadth models deteriorated, number one, if interest rates rose, and most importantly, if credit spreads widened. Credit spreads are tame now. They're about 500 basis points. If they got to 550 to 600 or more, that would be the danger zone. So in summary, we're very cautious on the market now, but there is precedent for a rally, even though our models are leaning negative now. We don't predict. We use our models to tell us what our positioning is going to be. So that's the update for this month. I hope you've enjoyed it. Please join us in July for the next update. This is Rick Cortez. Thanks very much.